Hi, my name is Aldo Lagrutta from the Technical Analysis Institute. In today's video, we're going to cover a lot of interesting subjects. What's an overbought? What's an oversold? What's an oscillator? What's the concept behind an oscillator? And what is divergence? If you find the video helpful, I hope it is very helpful to you. Don't forget to subscribe to the channel and like it.
We know that the market moves in waves and not in a straight line. When prices have gone up and the traders who are participating consider that it has gone too far and it is now ready to correct, it is said that the market is overbought. The term overbought refers to a situation where the price of a financial instrument is becoming overvalued and it is prompt to experience a pullback. When this happens, the price goes so high that an oscillator reaches its upper limit. I know we have not spoken about oscillators just yet. I'll tell you about it in a second. But before we get into that, let me clarify that oversold is the exact opposite situation of overbought. Obviously, if the price is becoming undervalued, it typically represents a great opportunity to buy. Now here is the question. How do we know when a market is overbought or oversold? If periods of oversold are such great buying opportunities and periods of overbought are such great selling opportunities, wouldn't it be great to have a system that could tell us exactly when the market is overbought or oversold? Indeed it would. But does such a thing exist? Fortunately, the answer is yes, it does, and that is what we called earlier an oscillator. An oscillator is a technical tool that indicates when a market is overbought or oversold. There are many oscillators available to a trader. However, in the Trading Made Easy program, we are going to work with the most common ones, stochastic and the Relative Strength Index or RSI. In this lesson, we're going to talk about the stochastic. Let's see how we can bring it up in our charts. First, you identify this tab here called Indicators. Click there and on where it says Search, type stochastic. Once that, you will see here the first option says stochastic. There are many options available. Just choose the first one, click there, and immediately you will see the indicator appearing right here. Let's take a look at the stochastic. Notice that it is formed by two lines. Those two lines are called %K and %D. Those names are not really important, but it's interesting for you to know their names. Both these lines oscillate from one extreme to the other. That's why they are called oscillators. It goes up and it goes down. The concept behind the stochastic is rather simple. Suppose that we're talking about an uptrend. If we're in an uptrend, prices will be moving higher and the closes, remember those little dashes on the right side of the bar, they will have the tendency to close near their high on the bar. For example, let's look at this. You can see right here how this is an uptrend, and you can see how prices are closing on the top of the bar. You can see all these bars are closing on the high. See, all this. So if we are talking about a downtrend, then prices will be lower and have the tendency to close near the low of the bar. And that is the theory behind the indicator. Now, let's see how we can use it in our trading. In the Trading Made Easy program, you learn the most common and effective ways to use stochastic. In this lesson, we're going to learn the first way, which is by identifying what is known as positive and negative divergence, or also called bearish and bullish divergence. Now, what is divergence? When price goes in a particular direction and an indicator that is based on that price, in this case is stochastic, does not confirm the same direction, we have divergence. In other words, price and indicator are moving in opposite directions. We can look at an example that I have prepared for you right here. You can see how prices here are moving lower. Notice that this one here is lower than this one. Now observe the stochastic at the same price. This low right here corresponds to this low, but the next low is higher, whereas the next low here is lower. So price and indicator are moving in opposite directions. Now, in this case, this is known as positive divergence or bullish divergence, right? The next one is right here. You can see how prices are moving higher. This high here is much higher than this one. Now notice how the oscillator does exactly the opposite. This high corresponds to this high, but the next high in the price is higher, whereas in the indicator is lower. A next example is right here. This low here is lower than this low, and you can see in the oscillator this low here is much lower than the next one, which in price is lower. And the opposite occurs again. When we have higher prices are moving up, the indicator is moving down. So this is a good example. In this particular market, you can see this is a one-day chart of the USD Swiss franc, but we can find this in any market. We can see several examples. Notice how prices are coming down, right? Whereas the indicator is actually moving up. See, the indicator this low is higher than this low, whereas in price this low is lower than this low and this low is lower than this one. So you can see the indicator is moving up, right? Whereas prices are moving down. In this case, you can see prices moving up, and notice what the indicator is doing. In the same period, the indicator is actually moving down. Okay, and here we have another example where prices are moving down, making newer lows, whereas the indicator does not appear to do the same. In fact, the indicator moves slightly up. Okay, and one more example for you. So another currency. Well, right here we have prices moving up, right? This high is higher than this high, whereas the indicator at the same levels, the indicator here is higher than this high, where prices is moving higher, the indicator is moving lower. Notice how here prices are moving a lot higher, whereas the indicator is during the entire time moving lower. So that is negative divergence or bearish divergence. This is also negative divergence or bearish divergence. In the case of the USD yen, we see several examples. In this case, we have bullish divergence or positive divergence, where the price is going down and the indicator is going up. Now we have negative divergence, where prices are going up, the indicator is coming down. Okay, and that means bearish divergence. Here again we have prices coming down, indicator going up, so this would be positive divergence or bullish divergence. What some traders call bullish divergence, other traders call positive divergence. In other words, positive divergence and bullish divergence are exactly the same thing. Positive divergence occurs when the price makes a new low while the stochastic starts to move up. Bearish or negative divergence occurs when the price makes a new high and the stochastic does not. In fact, it starts to move lower. As you can see, these signals show beautiful changes in direction, and they can be used as confirmation to good trade setups. By themselves, they are not always reliable, but they are good confirmations. However, they are of great use for you at this particular moment in your learning process. So your homework now is to identify all positive and negative divergence that you can find in your charts in different time frames, and then identify trade setups with divergence and actually take those trade setups in your sim account. You will see by yourself that there is a good percentage of divergences that works really nicely.